Happy New Year, everybody. This is Kirk Spano. It is January 5th, 2026. I said the year correctly. I'm very stoked about that. I haven't written any checks yet, but I'm sure they'll come out like 2025, maybe 2003. I don't know. I don't write many checks anymore, so we'll see what happens when I finally write one. Go to the YouTube channel and like some of these videos. I am starting a new show when I get back from Disney World next week. As I told you, I'm going to Disney World because originally I had to have a colonoscopy scheduled, just routine, and it's been delayed because I had to change insurance. However, I was like, what do you do after a colonoscopy? Well, you go to Disney World. So I'm going to Disney World next week. But when I get back, the thing that I've done a little bit of over the years is going to start, and it's going to be an actual show. I am going to be doing interviews pretty much every single week. That's the goal. Some weeks I'll do two, and then I could just release them the next week. But I'm going to try to release an interview with an executive or a tech person or maybe a politician here and there, just put on the channel, something to do with the stocks that we're in. So we will get a lot more interviews and special reports. I have 3 of them in the works. Kirk's Take on Stocks will become a regular feature. The Kirk's Take on Stocks will not be on the live part of YouTube. They will be unlisted, which means that you'll only find them in our chat room. And then after 3-4 months, I'll make them public. And then the Investment Trends Weekly, which a lot of things get buried in here. So if you watch the whole videos, you actually will get some of the stock takes. If you can pass these on YouTube and Facebook and Twitter and Blue Sky and whatever, Instagram, wherever you do social media, if you could put these up, I would appreciate it, because I make a few $100s a month on this. I mean, it's nothing special, but it's a way for me to keep the production costs low. So I just pay somebody to do the production. I finally hired somebody for that, just trying to break even and give you a little bit of value for the money. Almost free money selling options. If you haven't been an option seller in the past, watch this video. All right. I released yesterday the top punch card stocks to buy in 2026. I've been doing this research for months. A lot of these stock picks are not that new. Some of these stock picks are just things that, hey, we're looking for the right spots. We're trying to figure out how to make money on leadership in the markets, and we want to participate while there's something to participate in. And then if we get a bear market, which I think is inevitable, it's just a matter of how soon and how deep, how do we get out quick? And that really is something I'm going to start with here right now, is how to get out of stocks quick. Now, I believe that most people, and this is just based on experience, once they're in a stock, they're like, well, I got to hold it in case it goes up tomorrow. If the stock market starts to correct in earnest, the whole thing, virtually nothing will be insulated. Between now, which is when we think the risk is rising, and when the stock market actually rolls over, you still need to be invested in leadership stocks and catalyst-driven stocks that might buck the trend if liquidity comes out of the market. Remember, and we've talked about this a number of times, liquidity affects the S&P 500 the most. Everybody goes, what about small caps and mid caps? Don't they suffer when liquidity comes out of the market? Yeah, but the liquidity I'm talking about is the giant liquidity that moves the whole market. And what moves the entire market is the liquidity that flows from the employers to the employees to the retirement plans and to all the institutional investors. And this is the M2 money supply that we've talked about. If that starts to roll over, and the harbingers are bank lending and employment. If employment rolls over, if bank lending rolls over, then M2 is going to come down imminently, and you need to get out of the way. So those are your harbingers. You get about a 1 month lead time, maybe up to 2 or 3 months where you can start to see it happening. You can sell some covered calls, kind of game it a little bit for those last couple puffs on the cigar. Right now, liquidity is strong. However, it is not improving anymore. So it's still at a pretty good level, but it's no longer increasing. That means that we are either going to roll over or there'll be some new injection of liquidity. I don't see a lot of potential for an increase in liquidity short term. Now, could that happen by the middle of the year when the new Fed chairman is in, when the impacts of the big stupid bill take full effect? The big skim bill is what I've been calling it. Call it what you want. Big, beautiful bill. I don't really care. What I do know is that we are going to see some increase in liquidity at some point because there's a massive wall of debt coming. It's been in a couple of articles now. I don't need to show it to you again. Although there was a very good chart on the X today. See if I can find it. One moment, please. There you go. So there is a huge amount of debt coming due, which I've highlighted in a couple of articles now. A lot of the debt from last year will roll over into 2027, and a lot of the debt from this year will roll over into 2028. So we have a gigantic 3-year debt wall coming. At some point, we have to deal with it, and probably that means all roads lead to QE. During the financial crisis, liquidity was tight for about a year and a half, maybe 2 years. And it really started in 2007. Actually, probably started in 2006, but really started hitting us in 2007. The crash happened in 2008, so people think that's when it happened. Really, it had been happening already for a year before that, and then some, continued for another year. So if we get a couple of years of tight liquidity, which I think is coming, there will be a response on the policy side to pump liquidity back up. As I've said, I don't think that everybody in this administration wants to do it the same way that it's been done since 2008, which is just print money. I think they want to try to avoid printing money. I do think that there are some pretty cool ways to refinance the U.S. debt using Social Security as the vehicle. We'll see if the next crisis is the one where they solve some problems. I know a lot of people don't like President Trump, and I am clearly in the camp of not so sure I trust him. However, I don't think he's trying to burn it all down. Now, he might do it on accident. He might prioritize things in a way that don't benefit other people before it benefits him. I think that's a pretty diplomatic way of saying that. So that means that there could be a time delay. Not that things won't happen, not that things won't get done, but there can be a time delay before the things that we expect happen. So while I believe all roads lead to QE, I don't think I believe that it happens quickly. And if you think about it, the way that I think about it, which is I try to put myself in everybody's shoes, particularly the people with the big money checkbooks and power, what would be good for me? If I was sitting on a mountain of cash, waiting to invest in some things that I believed in on the cheap, what would I want to see? I would want to see a correction, and I'd want it to be a fairly deep correction so I could buy a lot of things on the cheap. I don't know if there is a loose affiliation of millionaires and billionaires and babies, but I suspect that there is. And that means to me that things that make sense typically happen at some point. So a very deep correction, whether it's this year or next year or the year after or the year after that, in the next few years, as we deal with this debt, we necessarily have to have a deep correction. I don't think there's any doubt about that. I mean, I put that at 99% likely. And then the policy responses will drive the rebound. And the policy responses, because there's no disease that's going to scare us, might not come quite as fast as they did during the financial crisis, where it seemed like the world shut down, or during COVID when the world shut down. It'll be more measured and take time. So you should be prepared emotionally that when I say, hey, you still need to buy some stocks, what that means. Somebody asked me, well, if you think there's a crash coming, why are you buying stocks? Well, it's because there's two different parts of the market. There's that S&P 500 driven piece, right? The S&P 500 market cap weighted, half of the people indexing, half of who's left not deliberately indexing, but actually they're indexing, right? Because they buy 3 large cap mutual funds or ETFs or whatever they do. It's quasi-indexing. So you have 60, 70% of the money basically indexing. So if liquidity rolls over, that's going to take a hit. Those S&P 500 stocks are going to get whacked. That's why I don't buy a lot of them, except after a big correction, because then it's easy. It's a layup. Where I typically play, where I typically invest, where I've made millions of dollars. And I talked to a couple of people in the last week who are now giving me money to manage. People who said, hey, this account was $200,000 a couple of years ago. Now it's $1 million. One guy, another guy, almost the exact same story. And they gave me, part of that money to manage because they said, hey, we made most of this money in AST, Space Mobile, Rocket Lab, Palantir, Bitcoin. Those are all your picks. Manage a portfolio of picks like that for me. So I'm going to. Might not work out as well. We'll see. But we are going to talk about a couple of those stocks today that I really think can do very well. And some of them aren't going to be quite as apparent to you as what you think might be the big winners coming up. But if you take a look at the article, whether you're at margin of safety investing or fundamental trends, there should be a couple of things that stand out. And the main thing is that technology will continue to be the big winner. So we're gonna talk about that here. In anticipation of a bear market, I'm still buying stocks because the small and mid caps, right? The small and mid caps are more catalyst driven than the large caps. Large caps are more liquidity driven. So in that small and mid cap space, where it doesn't take a mountain of money to change price, think about Microsoft, $2 or $3 trillion company, whatever it's up to now. To move the needle on price, a lot of money has to flow in. A lot of money. But on a $500 million stock or $1 billion stock, it doesn't take anywhere near the amount of money, a thousandth, literally less than 1% of the money it takes to move Microsoft to move some of these small and mid cap. So you don't need all the indexers to invest there to have these shares go up. Even if the indexers are losing their jobs or they're getting squeezed on their budget, the institutional investors, the guys like me who have, 8 figures to throw around, are buying some of these small and mid-sized companies that don't get a lot of attention from the analysts, don't get a lot of attention from the media, right? They just don't move very much until somebody discovers them. And then it gets into the memosphere, right? Somebody on Reddit finds it, and then 10,000 people read about it, and they all throw in $1,000. Or a guy like me finds a stock, sometimes right on time, sometimes a few years early, and buys it for 1/10 or 1/20th or 1/30th of what I think it's going to be worth someday. And that's where your 10 and 20 and 30 baggers come from, is rather than saying, oh, look, Microsoft went up, I'm going to buy it, $1 trillion company. I mean, seriously, what do you think you have an edge on there? Or I found a company like Cannabis just waiting for different things to happen on the regulatory side, which, regulatory things can take a long time to drag out, and that's what happened. But then they finally get the catalysts of a $17 million check the other day, and another $10 or $15 million check coming in the first quarter, and somewhere between 50 and 100 million coming from the first part of selling off the refinery in India, which they'll eventually probably get close to $1 billion for. And then you start to say, oh, a couple $100 million in debt's not that big of a deal, debt and CapEx, if you got $1 billion. And now all of a sudden you're like, well, what multiple do I put on $800 or $900 million of cash plus a revenue generating and margin producing business? You say, okay, let's say 15. And you go, okay, let's see, $1 billion times 15, that's $15 billion. When you game things out like that, the timing can be very frustrating. But if you buy something cheap enough, that's called your margin of safety. That's the actual definition. When you buy an asset for way cheaper than what it's going to be worth in the future, more likely than not, there's exceptions, there's things that never pan out. But that's where you as an investor have to make a judgment. This is likely to become worth about this much, and I can buy it for a fraction today. With Cannabis, people are getting frustrated. I've been waiting 3 years for this stock to go up. So people took the tax loss. Now they're waiting for it to go up. Well, when it goes up, it went up 20% the other day. When it goes up, if it goes up, it's not going to wait for you. It's just not. When they announce the IPO, when they start to get even more tax revenues, tax credits, more RNG revenue and more tax credits, and somebody with $100 million to invest comes in and says, we'd like to buy 5% of the company, that stock's going to go straight up and it's going to go fast. And I maintain that a Metis will be in the teens in the next year or two or 3 or 4, whatever. But when it happens, it probably isn't going to be a chart that looks like this. It's going to be a chart that looks like this. It's just going to go straight up and it's going to happen fast. Like it did a few years ago when it went from $1 something to 8. That took 2 months? It's going to happen like that again. So when we invest, we have to understand there's different categories of stocks. What I'm calling category 1 is your highest quality companies. They have a moat. They have a defensible business. They have below average risk compared to the S&P 500 in most cases, and they can beat the S&P 500. Remember, risk and volatility are different. Volatility is just the bipolar emotional reactions of the market and the traders in particular. Risk is what are the odds that something bad happens to the company. Entirely different animals. And if you equate volatility with risk, you're wrong. If you've done it a long time, you've been wrong a long time, and you need to get over it because risk and volatility are 100% different. Category 2 are stocks that have about the same risk as the market, but they can really crush the market. And a lot of times, I'd say most of the time, they're either tech or consumer related. Well, but what about dividend growth? Not a horrible idea, but you have to focus on the growth before you focus on the dividend. The dividend is a byproduct. The dividend is the byproduct of growth. Understand that and you'll be a better investor. You can grab some speculative growth stocks that are super high risk and, might be a 50 bagger, 100 bagger. I have learned that it's wrong to do that about 90% of the time or 99% of the time. And I throw biotechs into this basket. Even though I made my first $1 million basically on a biotech that just got bought out by Abbott, Exact Sciences, you don't see me investing in a lot of biotechs. Just way too many unknowns. I don't need to gamble with my portfolio. I can go to Las Vegas and gamble there. In the last few years, people have wanted to invest in mining stocks. And they ask me, well, what about this lithium producer? What about this gold producer? What about this oil company? And in most cases, I tell people don't do it. If you really think gold is a good investment, buy gold. We've talked about that going back, 10 years. If you really want silver, buy silver. The mining stocks are very heavy CapEx, which means that they're very dependent on mining. And when the commodity price goes down, they have leverage to the downside. So just buy the oil, the gold, or the silver if you can. A handful of you trade futures. I have bought a lot of physical gold over the years, right? Jewelry mainly, and some coins and a couple gold bars, things like that. A couple household items that are gold or gold rimmed. There's some extra value in that. You could trade the ETFs on gold and silver because they are physical. They hold physical or close enough to it that they don't get front run by the futures market. And from a bottom, you can trade the stocks, the miners, but they have to be from a cyclical bottom. Oil and gas is the same thing. I don't really like oil and gas stocks, but I learned how to trade them a long time ago. We are probably entering the last oil bull market here in the next several years, and then that'll be it. It'll be done. And it'll be done for a couple of reasons. First off, OPEC is going to need to get their oil to the market, and you're already seeing them do it. That means that supply is going to be available during the period of time when we transition from using more oil to using less oil because technology is taking us there. As the United States hits peak oil production, which is right about now, because over half of the gas is affiliated with oil production and the demand for gas is going up short term, there will be a pinch on natural gas. So the only stocks that I'm really invested in for oil and gas benefit from making a lot of money on gas that they hadn't been making before. And that's an important part of that equation. So whether it's Coterra or Permian Resources, and I've been in Matador, which has maybe been the best one, the idea of being in the oil and gas stocks for the oil is a horribly bad idea. We are at peak oil demand and peak oil supply in the United States. The numbers bear that out clearly. We're on a plateau. And when the extended range EVs come out in 2 years, just two, they're putting together production lines now. Hyundai, which owns Boston Dynamics, the robot company, and I've been looking at ways to get invested there, already is running one of their plants on robots. And their EREVs will probably be first to the market. I told you I love my Hyundai, and I'll probably buy one either from them or from Ford. I mean, I'd love to switch to Ford, but they have to basically stop making vehicles to get recalled every week. And you're going to see all sorts of oil stocks just get destroyed 4, 5, 6 years out. So can you trade some of them now because they're about to get a whole bunch of natural gas revenues that they weren't getting in the past? Absolutely, you can do that. And I'm doing that in a couple spots because they're kicking out huge dividends. And the stocks are probably going to double or triple before they peak, get bought out, go private, whatever happens to them. And of course, all the stuff that we don't know that an alien might find interesting. So even though my base case scenarios are that we get a choppy market or a corrective market in 2026 or 27 or 28, that I think that maybe a double dip recession is coming, or just a weak period in the market because of liquidity choppiness, that doesn't mean don't invest in stocks. It means go lower on the capitalization scale. And I know that that scares people. Oh, but they're not big and huge, and I can't see them every day on TV. Well, then maybe you ought not be handling all your money yourself. I know a guy. You need to go lower on the capitalization scale, and you might want to look internationally, or at least companies that do international business. Why? Because after a very long run in the United States being a leader on the stock market, we trailed last year. And I think the emerging markets are going to remain relatively stronger for a while, or at least trade off. And I think trading off is probably the more likely scenario, where for a year or two, the United States leads, and then for a year or two, the international markets, particularly the emerging markets, lead the young emerging markets in particular, such as India, which is hard to invest in because of their bureaucracy. We've seen that with the Metis. However, everything lines up positively for India and parts of Southeast Asia, some of Eastern Europe. Poland has done very well. And theoretically, I'll believe it when I see it, parts of Africa. If you want to be in S&P 500 stocks, you can pick them out or buy a couple of ETFs to make your life easier. I have traditionally been in QQQ, and that has been a good holding. I think that Tesla can fall between 50 and 70% pretty easy. So it's hard for me to be in QQQ right now. So I went looking for other ETFs. And I came up with the Roundhill Generative AI ETF, which is not normal for me to invest in a newer fund, but it's got to $1 billion under management pretty quick, so it's pretty liquid. And I had some criteria. I wanted it to own Microsoft, Google, and Amazon as top holdings. Why was that important to me? You remember why that's important? So the reason why that's important is that these are the three big cloud companies. They control just about everything on the internet somehow. Almost everything passes through Microsoft, Google, or Amazon, from B2B to consumer stuff, government, defense, everything. Oracle has been sniffing up that line, so maybe they become one of those companies. They're so heavy in debt, though, that I think that that's probably not something I really want to be in. And that's another reason why I went looking for different ETFs. Came out with the Roundhill Generative AI. All three of these stocks are in there. And then Tesla is not in the ETF portfolio. I did not want Tesla. Now, if you're okay with Tesla and Oracle, go ahead and buy QQQ. It's the easiest one, and a lot of money flows into those stocks, and there's some correlation there that you'll like. I'm probably going to use the one called Chat. I got rid of some of the other ETFs. You'll notice, if you go to the very short list spreadsheet that I have out there, that I changed some of the ETFs. I really focused it in on what I'm going to actually use. And that's something that I've been doing here for about 6 months now. Is I know that people want 1,000 options. Those are the folks that I have to rein in. You shouldn't need 1,000 options to invest in. Your goal is to only invest in the top 10% of investments. That's it. And if you're okay with that, then go ahead and buy QQQ. It's the easiest one, and a lot of money flows into those stocks, and there's some correlation there that you'll like. I'm probably going to use the one called Chat. I got rid of some of the other ETFs. You'll notice, if you go to the very short list spreadsheet that I have out there, that I changed some of the ETFs. I really focused it in on what I'm going to actually use. And that's something that I've been doing here for about 6 months now. Is I know that people want 1,000 options. Those are the folks that I have to rein in. You shouldn't need 1,000 options to invest in. top 10%. So that's what I'm going to try to give you. If it's not top percent, or I don't think it can be top 10%, I don't even want to throw it out there for you to look at. So while everybody else might cover it, I'm not. I'm not going to regurgitate it. Here are the top 10 holdings, and I like that Samsung and SK Hynix are in there. Micron is also holding. So you're basically getting everything associated with AI and the cloud. And when the market's going up, this is going to do very well. In fact, part of my criteria is to take a look at the performance. And you'll see chat was up 50%. It was the top performing one, even beat the semiconductor ETFs. XNTK, a more concentrated version of QQQ, because you can see that it also had Tesla, beat QQQ. So what's the lesson there? The lesson is fewer stocks tend to outperform more stocks when things are good. When things are bad, they can outperform to the downside, right? They trail. So a focused portfolio gives you a lot more upside, but also can be more downside, which is why just go to cash quickly if the large caps roll over, which is the point I was trying to make 20 minutes ago. All right. I cover some of the things that we look for. I go through the 4-step process, and then I talk about moats and defensible business characteristics. You'll find some industry, a lot of consumer stuff, at least for short periods of time, right? Because most consumer goods aren't favored for a long period. The iPhone's been one of the ones that have really stood the test of time. You're looking for barriers to entry, high switching costs, network effects, cost advantages, intangible assets, like government policy helping them. You want a large total addressable market, growth that can accelerate faster than the market currently expects, CapEx requirements that do not require onerous or significantly margin contracting financing, right? This is why most of the mining and drilling and commodity stocks are, the best you can do is trade them. The CapEx is a big deal. Try to avoid heavy CapEx in your portfolio relative to the financing. Now, there are inflections that you can play, which is kind of what I'm doing with Ametis, where the CapEx at some point peaks and then falls, and the revenues shoot through. I thought that would have already happened there. It looks like it's going to happen in 2026, so we'll see. Other companies that have high CapEx, usually the energy stocks that I'm looking for a spot where CapEx comes down, financing becomes much better, cash flow covers everything, and the share price takes off. When you take a look at Katera or Permian Resources, they gush cash flow, but nobody's interested in them. So the share price hasn't moved. When the share price doesn't move, people go, oh, it must suck. No, most investors suck. And that's true. The top 10% of investors make all of the excess gains. The next 60% of investors are right around the averages. And then 30% of the investors get waxed. So all that money that the 30% lose goes to 10%, so 3-to-1. And it might be 4 or 5-to-1. That's the same way that it works in poker and professional sports, entertainment, everything. All the money flows to the top. It's more extreme in some of those other things where it's only 1% making the excess return. But in investing, if you're in the top 10%, you're not only going to beat the market, you're probably going to get rich. If you're in the next 10, 20, 30%, you'll do all right. You'll be able to retire. So S&P 500 stocks, and I'm not going to cover all of our small stocks because that is just for you. The S&P 500 replacement stock, clearly Berkshire Hathaway. It performs about the same as the S&P 500, and it is maybe 30 or 40 or 50% less risky. Well, how can one company be less risky than a 500 stock index? Well, Berkshire Hathaway owns about 200 companies. It's its own index. And it was very carefully picked. And they have this weird thing where they own insurance companies and they get to invest money on their behalf that isn't theirs, the float. So Berkshire Hathaway is a good core holding if you want a core holding. Now, I own a little Berkshire Hathaway, not much, just so I can own it. It's good for client portfolios to give it some ballast. And it will typically outperform the S&P 500 by a point or two with way less risk, and really outperforms when the stock market does poorly. Why? Because they're sitting on a mountain of cash. I don't even know how much anymore, hundreds of billions of dollars, and short-term treasuries. So if you want to invest in SPY, which is 100% liquidity driven, invest in Berkshire Hathaway instead. They have their own liquidity. They don't care if the market rolls over. They'll just buy stuff with their cash. If their share price goes down, they'll buy their own shares. And frankly, I think the new investment manager, at least over the last decade, has been better than Warren Buffett. Warren Buffett was a great investor. He was at his best in the 70s, 80s, and 90s. But this century, the people that he brought in to replace him have been better. And now they're in charge. Big cloud, we talked about that, Alphabet, Amazon, Microsoft. If they're ever cheap, you want to buy them. They're rarely cheap. Alphabet was recently cheap. We should have loaded up on it, bought some QQQ instead. NVIDIA, semiconductors. I talk about the semiconductor ETFs in here. It is hard to buy semiconductor stocks individually. There's so many good ones. So in general, you just want to buy NVIDIA because they're the leader, and they will continue to be the leader, right? I mean, there's some consolidation going on in that stock now. Will they be as much of a leader in the future as they have been in the past? We'll see. They are becoming more vertically integrated, and I think that's going to offset some of the mild reduction in their moat. So if this corrects, you probably want to buy it along with a semiconductor ETF. It is the backbone of the entire tech economy at this point. And then your SPY leaders. Blackstone. Private equity is buying up the most valuable parts of the world, the best businesses. I'll probably stick with Blackstone because I don't love actually the management at Apollo. I love their resources, but I don't know that I love the company. KKR never seems to be cheap, and I think that they take more money out of the company than maybe they should. Right? You want to have shareholder alignment. Netflix is getting beat up because of Warner, and we're going to talk about Netflix up here a little bit. Uber, it is hard for me to love certain companies, and then when I still like them as an investment, they're usually really good. So Uber, we talked about, 4 or 5 years ago, respected the technicals, but probably buy the dips. Apple, Meta, Generac. Generac is the one that you look at and go, well, that doesn't fit in there. When you take a look at what their business is, and you take a look at what management does for buying back shares when they have the cash, this is one of the companies tied to the future of energy and homes. And when energy and homes are beat up, usually a really good time to buy this and get a 2 or 3 year run out of it. So there are some other stocks in the S&P 500 that you can get into. I have a list of re-rating and turnaround candidates. Remember what they say about turnarounds seldom turning. Katera, Pfizer, Ford, Comcast, Charter Communications, PayPal, Global Payments, and Fiserv, and Paycom. Those companies are dramatically undervalued in most cases. If they execute their business models, they're going to do very well, and they will close the gap. Now, does that mean you own them forever? No, they're re-rating candidates. So re-rating means they're undervalued, and you want to sell them when they get to become between fair valued and overvalued. So if we know what fair valued is, we can just watch the momentum as it gets there and then trim as it starts to lose momentum. One of the sweet spots in the market is consistently the mid caps. These are stocks that are growing. They're already of scale, and they are getting sucked towards the S&P 500 index as new components. As they get sucked towards the S&P 500 index, they accelerate like something getting tossed into the sun, right? It gets faster and hotter as it gets there. Once they're in the index, there's usually a consolidation period. So we want to find what we think are the next stocks, maybe not the very next stocks, but at some point in the next few years will be S&P 500 companies. And I have, I believe, 8 of those on the list. And then we have our small and micro caps. So let's take a look at some of the charts. This is the Roundhill Generative AI, right? Heck of a run. This is the LuxAlgo. Showed a sell signal a few months ago, and we got a bit of a correction. The RSI is right back in the middle. This looks like it'll come down, and then we'll want to buy it. There hasn't been a pay attention dot, so that's what those are. Those are the pay attention, and then you get your buy signal. So right now, it already had a sell signal. There is no buy signal. You typically buy when it's down in here. And these have been very good signals to within a month or two. In the chat over at Fundamental Trends, and I will put this up over at Margin of Safety when we're done here, talked about QQQ and the megaphone pattern that we've been tracking for a while now. So you had the correction in 2024. that established what became the megaphone pattern, because we got a lower low in 2025, but also a higher high. So you got a higher high and a lower low, created the megaphone. Got your choppiness around the line here. Right, you take the first one, chopped around here and then broke out. The likelihood is that it corrects down into here. There's a possibility it breaks down into the fair value gap. And if we're actually in a tightening liquidity scenario, it can break out all the way down here, break down all the way down here. And that is just the 2022 low region where you see this line. That line measures where you should expect buying to come in pretty heavily. We are in a situation where NASDAQ can drop over 50%. Now, will it happen? I doubt it. But you should be aware that it's not impossible. And you should respect the technicals. If momentum is down and there's not an intervention on a policy side, you let it play out. Don't try to catch that falling knife. Your signal to buy is when they tell you liquidity is coming. This is just 2022. It wasn't that long ago. It's not unusual to get full retracements. Is it likely? No. Is it unusual? Not really. It happens every decade or two. If we look at QQQ going all the way back, .com, it lost what, 85%? Financial crisis, it lost 55, 60%. And since the era of quantitative easing, it's been nothing but up. What I tried to prepare you for at the start of this call, so that the era of quantitative easing might pause before we go back to it. It is not hard to think that this chart comes all the way down in here. Now, can it break through? It can. I think that's unlikely. But this long-term chart in here, it's way more likely than you think. So be careful, because you might not actually have a landing spot until much lower than what most people are suggesting. Take a quick look at Blackstone. Since the era of quantitative easing began, they've done very well and really taken off since 2020, when we basically did QE infinity. They are buying the best things in the world. All the laws are in their favor, carried interest, everything. This looks to me like a double top, trying to fight back. But a correction down in here, again, seems reasonable to think it could happen. Take a look at the LuxAlgo, which has been spectacular. You got some signals to maybe trade it to the upside, then almost immediately got a signal to be careful out there, right? The little red dots are pay attention, and the little green dots are pay attention. The arrows are act. And sometimes you act on the little dot just because of your risk tolerance. I would love to own more private equity. If I were going to start my career over again, I would go into private equity. There would have been a lot more money in it for me. I think about things as best I can like a corporate executive. And I think that this is going to come back, and I think I'm really going to buy a lot of it. This might be my favorite S&P 500 stock, not because I think it'll do the biggest upside, but I think it'll have a really good risk to return ratio, whereby the risk is relatively low. The volatility gives me an opportunity to buy that low risk at a low price, and then I can ride it back up. I think there's going to be a lot of opportunities to double and triple money by the end of the decade, but you can't be a do-nothing investor. On the monthly chart, that last chart was a weekly. On the monthly chart, you haven't had a buy signal for a while, and you're getting a sell signal now. So those longer-term charts usually are pretty worthwhile. They don't come into play often, but when they do, pay attention. Netflix, they're down because of the Warner Brothers Discovery takeover. I think they're going to continue to come down. I think they might test their trend line down in here in the 60s or 50s. And if they do, I want to buy them. Why? They're a must-have streaming service, right? Everybody's got them. They don't have a lot of growth left in the United States. However, what was the rationale between Warner Brothers and Discovery merging? Warner Brothers content with Discovery's global reach. Why is Netflix buying Warner Brothers Discovery? Well, they get the library, they get the HBO team, they get all those talent relationships that they didn't have necessarily in the past, and they get the global reach, which is what they've told you in their earnings reports is necessary for them to grow. They need to become a global service versus the United States and a handful of other countries' service. They've started with Central and South America, Eastern Europe, some other places, and they're going to keep expanding. If we can get a price on Netflix, probably the one to have in that industry. Now, I like Comcast too, but for different reasons. You're never going to get a COVID boom like this again, right? You have to go through the trough of despair and then just buy it because it's going to beat the index. Now, is this a stock that I think is going to be the leader in the stock market? Will it be a top 10 stock? Probably not. Will it be top 10%? I think so, because everybody understands the model at this point. You have the pessimism from the merger causing a sell-off. If liquidity turns down, this is a big stock in the indexes, it'll come down. And then when they pump up liquidity, it'll go back up. Generac Holdings, right? Hell of a rally here. I think that they will test those tops again at some point. It might take 5 years, 6 years, but I think it'll happen. I think this is a pretty constructive chart. I like management a lot, and I like the market that they're in. A couple of sell signals, but they've recently been trading up. But if you flip over to the monthly chart, it's kind of ambiguous. You got a sell signal and a buy signal right on top of each other. So it's been trady. That's volatility. That's not risk. If I could get it down here again, price near 100, we almost bottom ticked this. Teresa, I think, bottom ticked this one. We get one more shot at this in here somewhere. That'd be awesome. Not so sure we get it. It is an S&P 500 component, so maybe we get lucky and we get a double bottom here. Get a double bottom here. This is a stock that you can make 500% on in the S&P 500. AST Space Mobile, a lot of you have a huge gain on this one, right? Heck of a rally. I think it's closing in on a top, and then I think it gets a pretty significant correction back down in here. Does it break the channel and come back down in here? I don't know. Volatility does volatile things. If we do get it down here, back up the truck. But I think that you can reestablish positions in here if downward momentum has dissipated. Rocket Lab, another one we made a lot of money on. I've been selling it. I actually think I like Rocket Lab better than AST Space Mobile at this point. I think that the vertical integration of the company, particularly given that we are militarizing space, is going to be very, very good for them. So I think that this one probably has a peak market cap higher than AST Space Mobile because of I think the defense contracts are going to get, right? They already got one. So you probably want to buy this on a pullback into the 50s or 60s, again, if the market's not crashing. Unusual Machines, I've been pounding the table on this one a while now. Huge update today. There's a triangle here that's formed. Normally you'd expect it to jitterbug more before it broke out. We'll see. The upside is pretty high. This is the weekly chart. This is the monthly chart. If we add the all chart patterns back in, and remember, you don't need to draw your own stuff anymore. Just use the algorithms. Find the algorithms that you understand and that you like. If it breaks out, this first move is middle 20s, and then you had the other price target up at 40 something. My intention here is to sell covered calls again if it breaks out and gets into the 20s. And then I'll sell the $40 covered calls, give or take. IIPR, Innovative Industrial Properties. I want to talk about this one. We'll finish up by getting a little high. I think that Innovative Industrial Properties is better than the Cannabis ETFs. I do not think you should own the Cannabis ETFs. I think that there is some meme potential with those. So if you want to trade them later at some point, that's fine. But I don't think you just want to sit on them. If you're going to sit on something related to cannabis, buy Innovative Industrial with their 14% dividend and look for a re-rating of cannabis stocks. If they change the cannabis scheduling, that's good for everybody in the cannabis space who rent. 14 of them rent from these guys. That means that they suddenly go from having to worry about defaults to not having to worry about defaults. Their entire balance sheet gets revalued when that happens, probably doubles very fast, and you're like, oh man, the dividend's great, but my stock just doubled. I really like that they have pivoted their $1 billion on the balance sheet from just sitting in money markets to buying distressed healthcare real estate assets that have 3 times the cash flow as a money market account. And because they're buying cheap at an MOS, a margin of safety price, they're buying good assets on the cheap. They probably are going to make a bunch of money on those, and they might even spin off another REIT out of this one. So while this is no longer a pure play on cannabis, it's still like 95% 5% cannabis. If the healthcare side becomes a bigger portion, and they'll say they buy some in the next year or two because they have cash flow at a time when healthcare real estate might be a little bit beat up, all of a sudden they can spin that off. We might get a special dividend from these guys of a whole nother REIT. I think that this is a stock that can make 300-400% pretty easy from these prices. You're collecting a big fat dividend while you wait. Cannabis isn't going anywhere. The oversupply has been shrinking. The weaker players have been falling out, and the survivors are going to lead that industry. So I think that this is a real easy one for you to buy if you're a dividend investor and you're looking for an opportunity to have the stock re-rate much higher on news that we've been told is coming. Now, when does it come? Who knows? We get told all sorts of things by the government that take years to happen. But I think that this consolidation down here is a pretty good consolidation. You got a buy signal. It's been repeating. These dots are telling you, hey, pay attention. And I think it's going to break out higher as soon as the market isn't hugely threatened. And it might happen sooner. If President Trump says, hey, we're rescheduling cannabis, right? Those studies, their question and answer periods, whatever they're called, should be done in the first half of the year. They might be able to reschedule this before the midterms. In fact, I would anticipate that cannabis gets rescheduled before the midterms, right? Because they want some of those votes. And I think this probably is going to have a heck of a run at some point. All right, let me take a look at the chat room, see if any big questions. Somebody mentioned that Dale Pinkard retired over the weekend. Was that planned? Nothing bad happened to him, did it? Yeah, he interviewed a lot of people. I'm not going to do a daily interview, but I'm going to do a weekly interview. And I think that, I think that will be good. Emerging markets, yeah, FRDM has been a very good ETF. New Fortress Energy, somebody mentioned to me that they thought New Fortress Energy was a tax credit play. No. New Fortress Energy has a modular technology for liquefied natural gas that's awesome. That's been very slow on the uptake. They've had some major problems with financing, but that happened because they got jerked around by foreign governments and the U.S. government on regulations and payments out of Puerto Rico after they bailed them out on their energy. So they are really just waiting to see if they can renegotiate their debt. That has to be renegotiated because the timelines on their revenues got delayed largely because of government policy. And now that the policies are seemingly in their favor, they're trying to force a debt deal that seems likely to happen because nobody wins in a bankruptcy. There are 3 different types of debt with the company. The first one is the 2026 debt that will probably get paid at close to par. They might get their interest payment as shares in the stock rather than in cash, but they probably get all their money out on the bond or 90% or better with a small spiff on restricted stock or warrants. I hope it's warrants. Warrants would be better because then they get cash later on. But whether it's stock or warrants, that probably gets resolved. There is the term loan. The banks seem very willing to extend that 3 to 5 years, probably at more favorable terms. And they also would either get warrants or restricted stock. And then the 2029 loans, which have some heavy hitters in there pushing for a better deal, that's all a negotiation. And the negotiation works like this. They know they're not going to be made whole. So they're trying to figure out, okay, A, how much cash can we get? It has to be more cash than we get in a bankruptcy. And then what can we get for the upside of the company, which will be shares or warrants. So we'll see how that plays out. There is a base level based on bankruptcy that everybody would expect, which is 30, 40, 50 cents on the dollar. So that's where you start the negotiations. The dilution that's priced into the stock right now is basically 99%, right? Because it came down 99%. So you're not diluting from today's value. You're diluting from where it was in the past. So if we take a look at a chart of New Fortress Energy, which is just a small holding, you take a look and you say, okay, were these prices right? If financing wasn't a problem, then probably. Financing has become a problem because the timeline got all jagged up. Again, it doesn't even matter why, but it's important to know why so that you know that it's over with. And it mainly is over with, right? They just cut the deal with Puerto Rico. All the Brazil stuff is going in the right direction. Their Mexico operations are good, and they're getting contracts around the world again. So they're basically at capacity. The utilities they run, some of them they can sell, which I would expect. That'll be part of the deals, is sell a couple assets so you have cash. And I would imagine that the share price on a deal gets back up to around 10 pretty quick. Now, over time, I think it can close the gap between the previous highs, but maybe only about halfway, right? It depends what the dilution is. So if the dilution, which is 99% at this point, ends up being less than 99%, right, then it goes up. I think the dilution is going to be 30, 40, 50%, right in that range. So that means about half of these peaks is what you'd expect. So it got up into the 50s. A price in the 20s suddenly makes a lot of sense, right? And this is kind of where the price had been. So I think that from this area and this area and this area, a price in here in the 20s makes a lot of sense, presuming nobody wants to burn it all down. We don't know that nobody wants to burn it all down. It would be those 2029 guys, the debt from 2029, because 26, we kind of already know what they're going to get. The bank guys kind of know what they're going to take. If the 2029 debt holders can find an acceptable deal, this deal gets done. If they can't, or if they just hate Wes Edens and they want to burn it all to the ground and they don't care about the money, then they burn it all to the ground. The odds of that happening are pretty slim. It doesn't happen very often. I know some of you sold this as a tax loss. I'm not telling you to buy it. But if you own it, you should wait to see what happens on a deal. Because if you lose another 40 or 50 cents at this point, who gives a shit? You have the potential to have a very quick 10-bagger and maybe 20 or 30 over time. So understand the nature of what's going on. Don't just say it went down, so it sucks. Understand why it went down. All the FUD is, oh, Wes Edens screwed up the company. And there's no doubt that he took out too much debt and tried to move too fast. And the speed of government and the inconsistencies of bureaucracy screwed him. It's going to cost him a lot of money. But he is the largest shareholder, and he wants to preserve some value in the shares. All right, I think we're done. My thesis on a couple of these other stocks have not changed, including the one I was just asked about. So take a look at the article, whichever service you're on, and visit the chat. We're in here quite a bit. Shooter still pops in, although he's got his own service now. So if you do want to swing trade, you want to trade more, then he's the guy. His time frame is a week or two. Mine is a year or two. Although I have done more of the quarter-to-quarter trading lately, as you can see by the changes in the punch card stock list. And I've pulled him in that direction just a little bit. So he's still a week or two trade guy. I mean, his moving average is 8 days. He's looking for 8-day trades or less. I don't have time for that. And my opinion is that unless you are a top 10% trader or have the time to become one, I don't know why you would bother. So look for charts that look like this, up and to the right, and buy the big dips. That is the best way to invest for most people who don't want to sit in front of a computer trading. Find great companies and buy the dips. Buy the dips. All right, have a great 2026. We will be back on Wednesday with a more in-depth macro dive versus what I started with today. A very in-depth macro dive. That article will be out on Tuesday night or Wednesday morning. It'll be my outlook with the different scenarios. If you take a look at the last couple of macro pieces, you can kind of put together where I'm heading with this, and I will handicap it. And I will tell you what to look for as a clue to if things are going to roll over and how bad it's going to get. And I've been trying to coach people and get you to think about the idea that maybe the cavalry doesn't come as fast next time, which means there'll be more downside. I could be wrong about that, but if nobody's talking about it, it tells me that maybe it's a little bit more likely to happen. All right. Have a fantastic day.